Well, one of my colleagues is a director of one of the big banks, Barclays, and I don't really know how he feels, but he must feel this is an impossible job, being member of a bank board. Banks are large, they're complex, they're difficult to understand and difficult to supervise. I think we probably can make some changes, but I have to say, I think the only way to stop another crisis is through structural changes in our banks. Banks are too big to fail, and we have to alter that. I think ring fencing, which was a proposal made by Claire and her committee, is a very good beginning, but I doubt that that is the end of the matter. I certainly am far less optimistic than I was a while ago. I think we should think about what is the advantages of size in banking, universal banking. This is not just a matter for the banks, it's a matter for the regulators as well. How could we split them up? Or will we have to impose much higher capital requirements on them? And there was a gang of 20 economists who talked about capital requirements of 15% or more. I remember Steve and I discussing it, and we thought 15% or more, it's inconceivable. It looks far less inconceivable today. So making banks smaller, imposing much higher equity capital requirements, we may just have to go that way. Why is it so difficult to monitor a bank? The bank can change risk so quickly. A 25-year-old, of course, not an alumnus from this school, could change the risk of the bank, bet not just hundreds of millions, but billions. It seems extraordinary. And can this happen again? Of course it can happen again. So there are no other organizations, I suspect, where people in the middle of the hierarchy of the bank can transform a bank and maybe even break it. There are mis-selling scandals. We keep on having them. There's LIBOR. You know, how do we, the scandals of banks, or scandals or errors, whatever you want to call them, seem endless. And what I think is interesting is, I'm sure the boards of these banks just didn't see these things coming. And the worrying thing is, I don't think the directors were bad or incompetent, not at all. I just think this reflects the complexity of banks and how easily bets can be made and decisions can be made well below the board. Imagine Rolls-Royce trying to change its leverage structure and some guy in the middle of the hierarchy doing it. It's inconceivable. Well, in the bank, the risk of a bank can be changed by people well below the board of directors. How to calculate the leverage of a bank is just a difficult job. You know, valuing assets that are not marketable, liabilities that are not marketable. I think the governance of banks is very, very difficult, and Claire is about to join the board of a bank, and all we can do is to wish her well. My guess is most of these directors just didn't know about these problems, and they persisted for so long. And that, I think, is truly frightening. So I kind of more in sympathy with the directors of banks, but I suspect they govern, without structural change, this problem will occur. However, there are some things we can do. I think the fiduciary duty of bank directors should be altered. They should have a duty of care, a fiduciary duty, which should be broadened to include depositors and the government as well as the guarantor. The idea that the fiduciary duty of directors should be responsible to equity holders who hold 5, 6, 7, 8% of the capital, and that excludes the stake held by the government or the taxpayer, I think is absurd. So their duty of care, just like I'm a pension fund trustee, I have a duty of care to existing pensioners, to future pensioners, and some duty of care to the company itself. So the fiduciary duty should be altered. This is a point, my next point is a point that George Dallas has made in writing. Give debt holders greater rights. We don't just want to see shareholder activism. It's very difficult to have shareholder activism when bank shareholders own 5, 6, 7% slice of the cake. And many of them hold stakes, very, very small stakes. So I would give debt holders rights pre-distress, pre-bankruptcy. If you like, I'm entirely quoting, I hope I'm quoting George accurately. I want to see debt holder activism, particularly in banks. And to borrow another suggestion of Anthony Julius, the lawyer at Michigan Dura, I'd like to see an ethicist. I can't pronounce it very well. But just like in hospitals, where there's somebody responsible for ethics that you can go to discuss, if you like, ethical dilemmas, I think banks and financial institutions should have them. You look at these 25, 30-year-olds, one of whom is in court, facing a serious criminal charge, and you wonder who he, did he go out to break the bank? I'm sure the answer is no. Claire, we were talking about it. Did he think what he was doing was wrong? Difficult to say, but one worried. Is there anybody for him to have gone to? So I think the idea of appointing an ethicist, somebody who can be consulted about moral dilemmas, ethical judgments, I think might be helpful. We have it in medical schools. Why don't we have it in banks and insurance companies? I think that is a good idea. And of course, there is compensation. I'm sure others will talk about that. I want to stress that I think on their own, these changes will not be enough. Banks are simply too big and too big to fail. And until we address that problem, I think we will not prevent another generation from having this problem. And of course, I must finish on a self-interested note. I think we should have a study on looking at the value of big banks. I mean, listen to Barclays. Universal banks is a wonderful thing. What is the evidence for it? And I think the regulator and the taxpayer should understand the value of these large institutions, because we know what the costs are, but we certainly don't know what the value is.